You bought a $50 gift card. You handed over real money. But there's a decent chance some of that money will never buy anything. Not because you lost the card. Because most people eventually just don't spend all of it. And the company selling that card is counting on it. In fact, they've already done the math. Here's how it's supposed to work. You buy a gift card. The store gets your $50. Later, you or whoever you gave it to walks in and spends it. The store hands over coffee or sweaters or whatever. The money you paid becomes a sale, clean trade. On the company's books, that $50 doesn't even count as profit at first. It's a liability. A promise. The store owes you $50 of stuff. So it just sits there, waiting for you to come collect. That's the obvious story: money in, product out, even trade. And for most of that card, that's exactly what happens. But not all of it. There's always a leftover. The $3.17 stuck on a card in a drawer. The balance you forgot in an app. The loyalty points that expired. The store credit you never used. Add up all those orphaned little balances across millions of customers, and you get something the industry has a quiet name for: breakage. It's the money you paid that you will never, ever redeem. And here's the part that should make you sit up. The company gets to keep it as pure profit. There's an accounting rule for exactly this. Under the standard known as ASC 6EU6, when a company can predict how much of its prepaid value will go unspent, it's allowed to book that unspent money as revenue, not when the card expires as it goes. They don't wait to find out, they forecast it. Look at Starbucks. People load billions of dollars onto Starbucks cards in the app, and at any moment the company is holding a giant pile of money customers have prepaid but not yet spent. A slice of that will never be spent. Starbucks reports that slice as breakage income. It's coffee money for coffee that will never be poured. And think about how strange that is. A coffee company books profit from coffee it never makes. No beans, no cup, no barista. Just a balance that quietly converts from a promise it owes you into money it keeps. The promise expires in people's memories, and the accountants are allowed to follow. So why is this so profitable? Because breakage has no cost. Think about a normal sale. You give a store $1, they give you $1 of goods, and those goods cost them something to make. Margin is what's left, but breakage isn't a sale. It's money you handed over for nothing in return. No coffee poured, no sweater shipped, no cost of goods at all. It is as close to free money as a real business ever gets. And the magic ingredient is scale. One forgotten gift card is noise. 100 million of them is a forecast. With enough cards, the fraction nobody redeems becomes almost as predictable as a coin flip over a million tosses. So companies don't hope for breakage. They budget for it. Now widen the lens. Airline miles work the same way. When you earn miles, the airline owes you a future flight. That's a liability. But a lot of miles are never redeemed. They sit, they expire, they get forgotten. The airline books the ones it expects you'll never use. These loyalty programs got so valuable that during the 2020 crisis, airlines borrowed billions against their miles programs. The points were worth more than the planes. Now the law does push back in two ways. First, in the US, gift cards generally can't expire for at least 5 years, and dormancy fees are limited under the Card Act. The card can't just quietly die anymore. And second, many states have unclaimed property laws called a sheet that say if a balance goes truly abandoned, some of it should be handed to the state, not kept by the company, so the rules carve into breakage. But here's why companies still love it. It doesn't depend on tricking anyone or running out a clock. It depends on something far more reliable: human forgetfulness. At scale, people will always misplace a few dollars. Always. And points are looser still. Loyalty points often aren't even regulated like cash, so the never redeemed pile there can be even bigger. So breakage is constrained, but it is very much not gone. So here's what you'll never unsee. Every gift card, every loyalty balance, every prepaid app wallet is a bet. The company is betting that a small, predictable slice of customers will pay and never collect. You think you're buying a gift. They're selling certainty that some of that money becomes profit with no product attached. That $3 on a card in your drawer. Multiply it by millions of drawers. That's not an accident. That's a revenue line. So before you let that balance rot, remember, your forgotten money is somebody's forecast. And once you see breakage, you'll see its cousin everywhere: companies that collect your cash now and pay it back much, much later, or never. Next case: float, the trick of making money on cash you haven't even spent yet.